and more than likely it's going to go down a little bit more. Part of it is uh, political reaction to his involvement with the Trump administration. Part of it is because of their pricing issue, product is not going anywhere. So I don't know what common Tesla shareholders are going to get anything out of it, but Elon Musk actually got a lot out of that. Now, going back to RAC, the so-called capital structure, either target or actual, um, which is shares of uh, different forms of capital, such as common equity, preferred equity, and debt in assets, and the required rate of return on these different forms of uh, capital. Let me briefly, common equity. It's like the, you know, common shares of the company. If I'm talking about NVIDIA, the thing NVDA that is being traded, preferred equity, economic or financially speaking, is a debt instrument. You promise to make a fixed uh, amount of dividend payments, which is called preferred dividends, until the end of time or end of company's existence, whichever comes first. Unlike dividends on common stock, preferred dividends are promises to pay dividends. With common stock, Coke is paying, I don't know, $2 a share dividend, whatever it is. Tomorrow, the board of Coke can decide they're paying you nothing. There is nothing legally you can do anything about it. Because common dividends is like, I got a lot of money in my right pocket. I'm going to put some of it into my left pocket because I am the shareholder. Preferred dividends are different. They're paid out of my right pocket, but it doesn't go into my left pocket. It goes into the pockets of the preferred shareholders. So they're promises. If the company goes bankrupt, those preferred shareholders have a claim on the company. They don't get too much priority. I mean, normally common shareholders in the case of bankruptcy or liquidation are the last to be paid. Preferred shareholders are the second to last to be paid. these kinds of things. So technically, preferred shares or equity are essentially perpetuities, and economically speaking, preferred dividends are essentially interest payments. For example, if you go and get home equity line of credit, most of the time, at least for the first 10 years, you pay interest only. Let's say, I mean, you're getting prime, currently what's prime? 7, I think. Not that it matters too much. So if I borrow 100,000 times, I'm gonna pay $7,000 in interest every year, or every month I'm gonna pay about 583 in interest. All right, but my principal basically after every month is gonna remain the same. In home equity loans, after 10 years, the loan becomes a 10-year mortgage. That's a different issue. With preferred stock, if I borrow $100,000, after every dividend payment, I still owe $100,000. The trouble is that maturity never comes. That's what a preferred stock is. So you're thinking, since they are essentially interest payments, for example, when I have a home equity line, I can actually deduct those interest payments from my taxes or from my taxable income, provided I'm not choosing standard deduction. If I have a lot of those, sometimes it's more profitable to deduct those, especially if you're filing single, more than likely it is. But, if you're filing joints, a lot of times it's not. But either way, as a corporation, if I have regular bond payments, those are interest payments, I can deduct those interest payments from my taxable income. So I made $200 million, but I also pay before taxes and interest. I also paid $50 million in interest on my existing debt. My taxable income is now 150. If my tax rate is 20%, I'm going to pay $30 million in taxes. But if those $50 million are preferred dividends, my taxable income is still 200 million. Preferred dividends, legally speaking, are not tax deductible. Even though economically they are debt instruments, just like dividends on common stock are not. Okay. So we're going to define RP as uh, required rate of return on preferred stock or cost of preferred equity as the annual dividend on that preferred stock divided price per share. That's because if you have a perpetuity, for a perpetuity that pays dollar DP as annual dividends and has a required rate of return of RP, value of that perpetuity is dividends divided by the required rate of return. You may remember this from the uh, dividend growth model. This is basically constant dividend case.